You don't need indicators to make you $2,000 a day. You don't need indicators to make you money in the markets. In fact, you don't need a system to make you money in the markets. What you need is a strategy. You need a business plan to make you money in the markets. You wouldn't start a business without a plan. I don't know anyone who would start a business without a plan. But the first thing you have to understand about the markets, this is really, really important, and that is markets are 50-50. It's a 50-50 game. You got a 50% chance of winning a trade, you got a 50% chance of losing a trade, no matter what system you're using, no matter how many indicators you got on your chart, no matter how many moons you've got looking to the left and how many moons you've got coming in from the right and suns that are coming up. It really doesn't matter. At the end of the day, when you take a trade, you've got a chance of winning, you've got a chance of losing. And in fact, if you're taking on trading, understand that you're going to lose half your trades. In fact, no, you're probably going to lose more than half your trades, particularly if you're a new trader. But I am going to take you to the charts today, and I'm going to show you a price action system that I've been using for the last 33 years that's worked for me, and in all likelihood, it'll probably work for you. I don't use indicators on my charts, just one or two lines, one or two resistance areas. That's all I need to trade with, because I understand that the market's 50-50 and I don't want to confuse myself. I've seen some traders' charts which are insane. If you look at the chart, there's like millions of lines all over the place and millions of little dots and things and goodies going on and things on the side and all the stuff that they give you with all these packages, and I get so confused. I look at the charts and I think, what are you doing? What are you actually doing? I don't understand. And the guy says to me, what do you think of this trade? I wouldn't know because I can't see the trade. There's so many lines in front of it, so many indicators in front of it that I can't really tell. To top it all, it's not only that, you're not only looking at one screen, there's like 54 screens on the wall, so which one should I look at in the first place? Really confusing. Don't go there, guys. Try and keep it simple. That's KISS. Keep it simple, stupid. That's the way it works. Guys, for those of you who don't know me, I'm Rob. For those of you who do know me, guess what? I am still Rob. And it's Coffee with Rob. We're having some coffee. And then we're going to go to the charts. We're going to have a look at the system. But don't forget, after we've looked at the system, I'm not going anywhere. Then I'm going to take you and I'm going to show you my strategy. I'm going to give you my business plan, totally free. Most of you have probably got it already. Those of you who have subscribed have already got the business plan. You know how to make money in the markets, and you're probably joining me on the live shows every Tuesday and Thursday, and you've got this in your pocket. So you don't really need to worry too much, but do stay around and do watch the strategy again, because it's good to go over it again and again to make sure that you understand what you're doing in the markets. But before we go there, guys, before we waste any more time, let's go and have a look at the charts, and let's go and see what kind of system you would use to trade in the markets without any indicators or without any RSIs or stochastics or Ichimokus or moving average crossovers or whatever else it is you use in the market. Let's go and see how we can do it without anything in the markets. And here's a chart, guys. This is a plain old chart. You look at the chart and you think, ooh, what's going on here? Well, let me move that out of the way so we can just see what we've got, right? And it's really, really easy. It's really easy. See here, you've got a chart. What have I done? I've simply drawn a resistance in at the top here. What's a resistance? It's an area where the price gets to and it rejects every single time. That means there's orders there that are pushing it away. And it gets there again and it gets pushed away again. It gets there again, it gets pushed away again. So that's an area of interest, of a rather important area. So if you go back on this level, you'll see there's quite a level there. There are higher levels to worry about. At the end of the day, this is the level I'm worrying about. At the moment, you can take it to that high up there as well. That high at the top here is probably more important than this resistance sometimes, but this is a really important resistance area. But I'm not too concerned about that at the moment because I'm buying long. So what I've got here is a major support at the bottom, same thing, what's happening with the support. Every single time the price gets down to the support, rejects it, comes down to the support, rejects it, comes down to the support, rejects it. Human beings are creatures of habit. What happened in the past will in all likelihood happen again in the future. That's how it works, because we're not trading against lines, we're not trading against maths, we're not trading against algos. You know what we're trading against? Trading against other human beings in the market who want to make a profit. Here's the thing, guys. Everybody in the market thinks they're going to be profitable. Everybody in the market believes they're going to be part of that 30% that make the profit. They don't believe they're going to be part of the 70% of the people that lose. They believe they're going to be part of the people that win. And for the day traders who trade the 5-minute charts, They believe that they're going to be part of the 1% that are going to win, not the 99% that are going to lose. Did you know that 99% of traders lose on 5-minute charts? Can you believe it? Crazy, isn't it? Now, one of the adages that we have is the more times that a price hits a support or a resistance, eventually it'll break through. But I mean, that's just common logic, isn't it? Because at some stage or another, it's going to break through. But it's like chipping away at a wall. You're chipping away at a wall, chipping away at a wall, and eventually you make a hole through it and it breaks through. And that's the point. You're breaking through the support. You're breaking through the resistance. So somewhere down the line, that policy is going to fail. But in the meantime, while it's hitting that area, you can trade it. So it's so simple. Now you've drawn a line at the bottom, you've drawn a line at the top. But now what we've got with this particular trade is we've got a line in the middle as well. Now we've got another line, we've got a middle line. There's two areas here. There's a range that it's trading here, and there's a range that it's trading lower down. Sometimes that happens, sometimes it's not only one range, but you've got your wider range and you've got your interim range that you're working with. Now there's three ways that we trade. The one way is trade with the trend. The trend is your friend. The second way is we trade in a range, whichever that range is, which is between the 2 points. And the third way is breakout trading. Breakout trading is when it breaks structure, when it breaks out, either from a resistance or a support breaking down, or it breaks through a trend. The three ways that we trade is the way to make money. Now, what I do is I simply look at what I've got. Now here, I've got two things in my favor. I've got the range and I've got the trend in my favor that I can work with, and I can counter trade it. So there was many ways that you could take this trade. Now we've got a trade here. So what we're looking at is it hit resistance, it's come down, and we've had a bearish trend. So for those of you who don't know what bearish is down, bullish is up. Come on, you should know this by now if you're trading. Now what we've got, this is coming down, and there's a trend resistance line that I've drawn in here. Why have I drawn a trend resistance line in there? We're in a range. This is very useful to take a short-term trend resistance line and draw it in, because if it breaks that trend resistance line, it's broken structure and it's going to the other side. So then you know within that range, it's moving to the upside now, it's gone bullish. Now, a trend line is depicted by three touches. If it touches 3 times, you've got a trend line. Also a resistance line. If it touches 3 times, you've got a resistance. If it touches 3 times at the bottom, you've got a support. Easy peasy, not difficult, really easy. And then all you do is you either trade in that trend. If you get a green candle coming off that trend, going a red candle going down, you would go short. Get the green candle breaking to the upside. You take the green candle and you go long. What many traders will do is they'll wait for the retest. They'll wait for it to come back and retest before taking the trade. I often don't do that because the retests often don't work. But in this case, it would have saved your bacon, because here you would have taken the green candle on a breakout to the upside. So if you're taking that trade up top here, you would have taken that green candle and said, I'm going long because it's broken out, so I'm taking that trade. So you take that trade, you go long, and it comes back to retest, and the retest fails and it breaks down and it breaks back below into the range. So there the retest would have saved your bacon, because you would have been waiting for a green candle to come out there before you would have taken the long trade. So in that case, a retest would have saved you bacon. But what I find with the retest, waiting for the retest, is very, very, very often it just keeps on going up and you don't get the retest. For example, I think we have that example right here on gold, where I was actually literally waiting for the retest on gold here. When it broke to the upside, I thought, oh, this time I'll actually wait for the retest. I shouldn't have, because this is what it often does. It just keeps on going and off she goes and she leaves you behind. FOMO would be a problem here, because you get FOMO, you don't want to miss out, so you don't want to wait for the retest, and then FOMO would have paid off for me here. Effectively, what happens is normally it would come down retest, you'd get another green candle going up, and you'd buy it. What I normally do these days is if I get the second green candle going up, I buy it, and off she goes, and I stay with that trade, and I follow it up. Because that's a breakout. It's broken to the upside. You've got the second green candle. Go for it. If it comes back and retests and it works, then it doesn't really matter anyway. The big problem comes in with the ones like we saw previously, where it breaks to the downside and you end up with a terrible trade. In other words, it comes down, breaks to the downside. So this is why you have a stop loss, and this is why we have a strategy. So I'll tell you what, let's go and talk about our strategy. Let's go and have a look at why we need a strategy in the market to stay profitable, to stay ahead of the game. Now, the whole point of a strategy is this: to make a profit. And how do you make a profit in the market with a strategy rather than lines? Because a system can't make you money. Charts can't predict the future. You can't predict the future. In fact, there's not many things that can predict the future. In fact, even fortune tellers with crystal balls can't really tell the future. So you're sitting here not knowing what's going to happen next, except you can see what happened in the past on the charts. You can see that. And then you can kind of work out what might happen in the future again. You can think, well, if it happened in the past, it might happen again in the future. So that's what you kind of use the system for. It's a high probability trade. You're looking at a chart and you're taking a high probability trade. But what you can do with that chart, really importantly, is you can manage your risk. Because now you can actually manage the trade. You can manage the risk with that chart. More difficult on order flow and that sort of thing with numbers to trade there and manage it there. It's much easier to manage it on a chart. So that's what the chart is for. The chart's not there to make you a profit. The chart's not there to predict the future. The chart's there to give you the high probability and the ability to actually manage your trade. Now, what you have to understand in the market is how to manage that trade and how to actually make a profit. So how do you do that? How do you actually go about this? Well, the first thing you've got to do is choose the size of your account. And if you have more than one account like I do, that's fine, because I like to split things apart, because I don't trust brokers and things like that with money. So I'd rather have it all split up. But let's say you have a $25,000 account. Make sure you keep the account size the same. Don't change the account size just because you made a slight profit. If you make a few $1,000s, withdraw the money and keep the account size at $25,000. If you so decide that you would now like to have a $30,000 account, make a conscious decision that you've decided that that will now be a $30,000 account, and work with it based on that basis alone. Don't let account sizes change and grow and walk away with your profit. Because one day you're going to wake up on Monday morning and the broker's going to go, so long and thanks for all the fish, I'm out of here, and thanks for the money. So don't get yourself tied up in that. Be very careful of that. Make sure you withdraw your profits. Keep your brokerage account the same size at all times. And if you can, split the accounts. The basis of the thing here is to work on your risk management. So I risk 1% on every single trade of any particular account, no matter what the size of the account. So if it's a $25,000 account, you are risking $250 on every single trade. You're saying, well, it's only $250. That's not a lot of money, is it? That's like, how am I going to make a profit? Well, that's entirely up to you. If you want to risk 10% per trade, guess what? Lose 10 trades, you're going to lose all your money. Whereas I lose 10% of my account, easily recoverable. And on top of which, I'm risking 1% on every single trade with a basis of trying to make far more in my wins than I lose on my losses. So I now know exactly what my risk amount is on every single trade. But how do I choose that risk amount? Let's go back to the charts quickly and let me show you how you do that so that you understand this clearly. What you do is you've got a trade like this. Let's say you want to go long on this particular trade at this point. So all you're going to do is you're going to say, I want to buy this. And it's quite simple. So you go to the right here and you say, well, there's my stop loss. Let me work out how much is my stop loss going to be. So you just take it here and you go, how many lots can I buy? This is 1.81 US dollars. So I want to lose $250. So if I make this 0.1, it'll be $18. If I make it 1, it'll be 118. If I make it 1.2, it'll be 217. If I make it 1.4, 1.4, $250 loss. Suddenly, I know exactly what size my trade should be. Suddenly, I know exactly what I'm looking at. So now I know that 1.4 that would be if my stop loss was right here. So I don't actually want that. What I want to do, the first thing I want to do is I want to look at this area here and see where I want my stop loss. So if I buy this here, I want my stop loss below this red line. So it'll be 137.1. So I'm going to have to change this stop loss amount. And I'm going to have to change the size of the trade as well, because that will make my loss $900. And we don't really want that either. 0.4, that's much better. 0.4, $250. Now we know the size of the trade. Now we know the exact size of the trade. So that puts the stop loss down here at 137.1 down here below the red line, and it will take my take profit will be at 139.5 up there. So then you just take this and go, if I make my take profit 139.5, then I'll make $438. Now, if you look at that, immediately you can see that I'm losing or risking $250 for a profit of $438. And that seems pretty fair to me. I'm making more on the win than I'm risking on the loss. The whole point here, guys, is not to, just coming back to this, is not to try and make $50 while risking $250. You want to be trying to make more than the $250 at all costs. So that's the idea of making a profit in the markets. Because I know you guys, if it goes into a loss, you'll start dollar cost averaging, you'll start moving the stop loss away, and make sure that stop loss that you choose is an invalidation area. So if the price gets there, you're not going to think, oh, let me move the stop loss away because I want to stay in this trade. What you want to do is you want to get out of that trade. So you want to let it go. And in fact, if you can get out of the trade earlier because you feel like the trade is going pear-shaped and it's not working out in your favor, do so. Get out as early as possible. But funnily enough, when we go into a profit, we don't let our profits run. We decide that, you know what, I want to get out of this profit as early as possible, as quickly as possible. You see $50, you see a bit of green, you click out and off you go. Those are the most painful trades, by the way, because when you see that thing go up and it could have made you $1,000, then suddenly you're looking at it and thinking, why didn't I stay in that trade? That's actually more painful than losing. So managing your profits is actually more difficult than managing your losses. Managing your losses can actually be quite easy in comparison, because managing your losses allows you the opportunity to understand that you're going to take a loss. You understand that you're going to lose because you've taught yourself, because I've been hammering it into your heads, that there's a good chance that you're going to lose. So now you know, hey, Rob said I'm going to lose off my trades. So I understand that I'm going to lose this trade. So that's okay. I lost that trade. I'll win the next one. But when you go into a win, then suddenly it becomes a different story. Nobody taught you anything about that. Nobody said, well, hang on, if you're going to a win, you want to follow that win and you want to be making as much as possible. You don't want to be getting out of that. And that's the difficulty. So now you're going to profit and you see the profit running. You see it going up to $50, $100 and you click out and you take a small profit. If you're that nervous about your profits and you're that worried about losing your profits and that little bit of profit that you want to take, all you have to do is take your stop loss, move it up to cost. When you took the trade was costing you $250. Now you take the stop loss, move it up to cost. Guess what? You've got a completely free trade that's absolutely costing you nothing. It's costing you nothing. It's now totally free, and you can just relax and come back and see how the trade is doing. If it takes you out at cost, don't worry about it. You didn't lose anything. You didn't lose that $100. You haven't lost anything yet. It's funny how when you go into a loss and it comes back to cost and you get out at zero, you go, phew, I got out of that one. But if you go into profit and it comes back and goes out at cost, you go, ooh, I lost $100, rather than going, oh, well, I didn't lose anything anyway. It was okay. Phew, that's okay. It's actually quite a good trade. It didn't cost me anything. What you've got to look at is you want to make as much profit as possible. So you want to follow that thing up as much as possible. So let's say your profit target's like $500, like it was there, 400 something. Now it goes $250, $300 into profit. Take the stop loss, move it up behind it, maybe $200 into profit. If it comes back, you make a couple $100 profit. Or you move it further and further and further. Most of my profits in a year are made from one or two big trades, big wins, and a number of medium to larger wins. There'll be a large percentage of small wins and losses that are in there that'll be mishmashed around. That'll be about 60% of the whole trading game. The small wins and losses in there that are just all over the place. And the small wins are because of the stop loss moving back and taking out the stop loss early, or taking out, you moved your stop loss up to cost or $50 into profit, comes back, takes it out. It's still a profit. And it's showing as a profit on your statement, but it's kind of small profits all around and tiny little profits. And people think, well, you're taking profits early, but you're not. It's actually just the way the game works. And then there'll be a whole lot of small losses and the full losses of 1% and so on all the way through that game. But most of the money's made on those couple of big wins that you take and those many that hit target and do quite well. Because when something gets to target, you don't have to take target. You push the target away and you move your stop loss up behind it in the view that it might even go further and make you an insane amount of money. Guys, If you want to trade of the day every day and a few perks on the channel, go and join the members area, join us there. And if you don't want to get that far into it, I mean, at least subscribe if you watched the video this far. Give us a sub and stay with us and enjoy. Join us for the live shows every Tuesday and Thursday. Those are really, really important to answer a lot of questions there, and I go through a lot of the information there. But that's basically price action trading. So I want to thank you for watching. Keep your feet on the ground, reach for the sky, and peace out.